what we're going to be looking at here is a lump sum sale of a stock with bond here, and we're going to have to use the incremental method to account for this lump sum sale. And for example here, Corporation A has issued 1,000 units here of a bond plus stock using a securities dealer here to sell these units here, and each unit sold includes, well, point one here, bond at 1,000 par value here. Well, the stated rate of interest of 12% on this bond equals its yield here, so it's going to be issued at its face value. So there's going to be no premium or discount on the bond. What they're going to receive here is $1,000 for each of the bonds sold. And what the other part of the unit here includes is common stock, and it includes 10 shares of common stock. We know the par value at $5 per bond here, or per stock here, and the market price is unknown. It's thinly traded here. So what we know is just our bond price here, but we don't know the selling price here of the stock. Now, each unit sold is going to be sold to outside investors, and we're going to receive $1,700 per unit, and that's for one bond here at $1,000 par value here, plus 10 shares of stock that's going to be sold for each of the $1,700 that we receive here. Now, the dealer here is going to retain 40 units as an underwriting fee. So of the 1,000 units issued here, dealer retains 40. So what Corp-A is going to receive here is 960 units. The receipt here of cash on 960 units. So in this case, we have to use this incremental method for this lump sum sale, because this is what we know here. The fair value of the securities known here is going to be our bond here as our basis. Now, the remainder here is unknown, so we're going to have to determine that here. So the remainder of this unknown amount, our common stock here on this lump sum sale, goes to our is allocated to our common stock. We know what our bond amount is, but we have to allocate the difference between our lump sum sale, and that's going to our common stock here. So what we have to do here is we have to determine the additional paid-in capital here for this common stock, and we'll look at it here where we deduct our issue costs. We'll go through this calculation. So our lump sum receipts here that are going to be those 1,000 units that are sold here, less the 40 units, the underwriting fee here of 40 units, so we're going to have a total here of 960 units that are sold, times the unit price that we're receiving here of $1,700 per unit, and that equals $1,632,000. So that's the lump sum receipts here that Corp-A is going to receive. Now, we're going to allocating our bonds here at its fair value. Well, we got 1,000 units here again, 40 units as our underwriting fee, and the unit value here of our bond, it was issued at its face value here at $1,000. So 960 units times $1,000 per bond that's being received here, that gives us $960,000. So now this is where this incremental method comes into play here. So we know what our bond's fair value is here, $960,000. We know what our total lump sum receipts are here, $1,632,000. So the difference gets allocated to the common stock. So the common stock gets an allocation here of $672,000. Now, we know what the par value of our common stock is. That's $5 per share here. We know that there's 10 shares per unit, 1,000 units here. So that amount here, our total par value in our common stock would be $50,000. So the difference here between the total allocation here to our common stock, $672,000 less the $50,000 here, gives us our common stock, the additional paid-in capital here above the par value here of $622,000. Now, the $622,000, that's the additional capital is paid-in capital is reduced here by those issue costs or those broker fees that we included up above here. So that's how we gone out and we calculated this additional paid-in capital here to our common stock. And that, with this incremental method, just remember here, you take your lump sum receipts here, less the securities that you know their value here. We knew what the bond value was, $960,000, the fair value. So the difference here got allocated to stock that we didn't know here. So, okay, we calculated additional paid-in capital here to our for our common stock at $622,000. Now we got some other we're going to go and we're going to calculate that as well here, but we also have to calculate the issue costs here on those bonds. But let's just go through our math here, our arithmetic here. So we're going to allocate the receipts between our bonds and our common stock. So lump sum receipts here, 1,000 units times $1,700. That's a total amount here. That don't include those reduction for our issue costs here. Total amount here is $1,700,000. That would be the total lump sum receipts here. Now allocating to the bond, well, we got 1,000 units and one bond per unit here at $1,000, so there's $1 million accounted for here. So the balance goes to our common stock, simply the difference between the lump sum receipts here, $1,700,000 allocated to bond at $1 million, so a balance goes to our common stock here at $700,000 here. Now remember, that isn't reduced by the issue costs here. Now taking our less our par value here, 1,000 units, 10 shares per unit at $5 par value, that's 50,000 again. The difference here between the common stock at 700,000 less the par amount here, 50,000, gives us a total additional paid-in capital here of excess above par here of $650,000. Now this is where we're going to subtract out our issue costs that we're going to calculate before. So our issue costs here we're going to calculate to be $28,000. So the difference between our total excess of above par here of $650,000 less the $28,000 issue cost gives us our additional paid-in capital here reduced by our issue costs here of $622,000. Same as we calculated up above here, but that was based on our gross receipts here. Now let's look at how we calculated this $28,000 here as our issue cost, and also what we're going to allocate to our bond issue costs here. So here's where we have our issue cost allocation. So our total issue costs, those were those 48 units that we have to pay we have to give up to the broker here, times $1,700 per unit, that's $68,000. So that's our total issue cost that we're looking at. Now this is where we are going to do our issue allocation here between our bond and our stock. So with our bond, well, we have a total of $1 million that we allocated to our bond up here, plus we look at the total receipts here of $1,700,000. So the fractional amount here, $1 million for the bond divided by the total receipts here of $1,700,000. That fractional amount times our total issue cost here of $68,000 is going to give us what we allocate as our bond issue costs here at $40,000. So again, this is where we use our incremental method here. Total issue cost that we have here is $68,000 less what we know for our bond here at $40,000 gives us $28,000 here for our common stock. And again, our common stock, we can look at it in these terms above here. So our balance that we had for our common stock, that was $700,000 here, divided by the total receipts here, $1,700,000 here. So that fractional amount here times the $68,000 here gives us that $28,000 issue cost. So the common stock portion is the portion that would be a reduction to additional paid-in capital here for a common stock. So that's how we calculated that here. So we were able to allocate our bond amount here, issue costs at $40,000, and our common stock here at $28,000. So this is how all this comes into play up here. Okay, so now let's go and let's look at how we'd record this here. All right. So what we're going to have here, we're going to have to deal with several things here. We're going to have our cash receipts here, we're going to have a bond payable here, and then we're going to also have that common stock along with our additional paid-in capital. So let's just go through these accounts one by one here. All right. For our cash receipts here, well, we already calculated that. This is where we have that common stocks, additional paid-in capital. The issue costs here would be deducted from these cash receipts. So our lump sum receipts, that was the 1,000 units here sold less the 40 units here that are being held by the dealer for their issue cost or their issue expense or their expense they're charging. So we had again that 960 units here times $1,700 per unit, and that's what we calculate, $1,632,000. So we debit our cash account for $1,632,000. Now moving over to our bonds payable here on our balance sheet, remember that those were at $1,000 par value here. There was no discount or premium on the bonds, and there were 1,000 bonds, or one bond per unit here sold here. So we have 1,000 bonds here at $1,000 par value, so we credit our bonds payable here as a liability for $1 million. So that total units here, 1,000 bonds at $1,000 par value, liability here as a bonds payable for $1 million here. Again, they were issued here at par. Now, moving over to our common stock here on our equity account here on our balance sheet here. So again, the par amount here is easy to calculate. Those were 10 shares here per unit sold. There was 1,000 units sold here. 1,000 units, 10 shares per unit, $5 par value. So we credit our common stock here for $50,000. Now, if we move down to our additional paid-in capital here for common stock, well, we'll go through our calculations. This is the review of what we calculated before here, but our additional paid-in capital here, our total amount here is going to credit that for $650,000. And then we're going to deduct our issue costs here of $28,000. A net amount that we're going to have additional paid-in capital is $622,000. So again, we can go through here and let's look at, we'll just go through this here. So our total issue cost, we looked at that before here, 40 units times $1,700 per unit, that was $68,000. Now, less our bond amount, remember that fractional amount, total bonds here at $1 million over total receipts are $1.7 million, that times the total issue cost is $68,000, that gave us $40,000 here. Okay, maybe we ought to look at this real quick here, the $40,000. So we calculated what our bond issue costs were here at $40,000. So let's go up here and we'll look at that. Now that becomes an unamortized cost here on our balance sheet under our assets here, bond issue costs. So debit that here for $40,000. So that's where our issue costs here in our bond ended up here as an unamortized cost here under our assets on our balance sheet here. Okay, so we had our bond issue costs here at $40,000, total issue costs at $68,000. So our common stock, the balance will go to $28,000, and that was simply our fractional amount here of total allocated to common stock of $700,000 less the total sales here of $1,700,000. That fractional amount again times our total issue cost of $68,000. That was $28,000 here. And then we looked at it both here as a fractional amount that we used plus it just was the net amount here between the total issue costs, what was allocated to the bond here at $40,000, that gave us $28,000. So we've taken care of both of these here. Now maybe we ought to just review this one more time here, how we got the $1 million here and $1.7 million here and so forth, how we come up with our allocation here. So again, our lump sum receipts here, 1,000 units times $1,700 per unit, $1,700,000 allocated to a bond. Well, there were 1,000 units sold here and one bond per unit at $1,000. That gave us the $1 million here, and then the difference gone to our balance stock between our lump sum receipts of $1,700,000 less what was allocated to the bonds that were fair value at $1 million here, gave us our balance to our common stock here at $700,000 here. And then our less our par value here on our common stock, 1,000 units, 10 shares per unit at $5 par value. That gave us $50,000 par amount here. Subtract that here from our balance in our common stock of $700,000, and we get our common stock here to total additional paid-in capital here in excess of the par value at $650,000. I'm just running through that here to show that up here. So that's how we calculate our total additional paid-in capital here of $650,000. Not to confuse everything here, but that was what we total amount here was $650,000, and we would subtract out our debit. So we credited our additional paid-in capital here for $650,000. Then we debited for those issue costs here at $28,000. So our net amount here, additional paid-in capital, is $622,000. So if you balance our credits of $50,000 here plus our $622,000 in additional paid-in capital plus our bonds payable here of $1 million. And remember, our common stock is part of our equity here in the balance sheet. Our bonds payable is a liability here in our balance sheet. Our credits here between our common stock and our bonds payable here balances with our cash amount here received here plus the unamortized cost on the bonds here. But what we wanted to look at here, just to go over this one more time here, is those issue costs here. Remember we calculated them. That was critical here, and how we allocate our issue costs here. And when you're dealing with this additional paid-in capital, you reduce your issue cost here, but you reduce your additional paid-in capital here for your common stock for those issue costs here. And with the bond here, well, what we did is we capitalized those costs. We essentially capitalized the bond issue cost here of $40,000. Now these would have to be amortized down over the life of that bond here, but in the case of their bond, just remember you capitalize them here as an asset, amortize them down, and then with your common stock, the additional paid-in capital, you would reduce it directly here, your additional paid-in capital, by the amount of those issue costs here. So not to confuse everything here, but I guess what's important to pull out of this here is how you allocated your bond, your issue costs here. You took you just take your fractional amount here. Well, the bond, you know the price here, so you can do your allocation. So the total sales here in the bonds would have been $1 million over the total sales here for those units of $1.7 million. That gives you a fractional amount here to determine your issue costs, and then your common stock. That was that total amount of allocated to common stock here, $700,000 divided by the total lump sum receipts here of $1,700,000. So that gives you the amount here that you're allocating to your common stock here for your issue costs. But the big thing here is to look at those issue costs here and how you allocate your total additional paid-in capital here for your common stock. Okay, so these are the key things you can focus in here, and how you allocated your percentage, or you allocated here your total costs here between your bonds and your common stock, and also how you allocated your costs here, or your issue costs here between your bonds and your common stock. All right, so that goes over the incremental method here. And again, the incremental method here is used where, in this case, we didn't know the value of our common stock, but we knew the value of our bonds here, and we knew our total costs. So it was simply taking our total costs or receipts here and using our bond here as our basis here, and then subtracting the balance goes into, in this case, what we didn't know as our security cost or as our common stock here. Not to confuse everything here, but you can see it down here maybe a little better here. Lump sum receipts, and then we knew what our allocation was to our bonds here, and then the balance goes into our common stock here. Okay, so that takes care of a lump sum sale here with bonds and stocks here using the incremental method.